Wall Street is currently betting on a single massive narrative. The stock market is breaking record highs, driven by the belief that generative AI will transform corporate efficiency and unlock a new wave of profits. This chart tracks the S&P 500 against U.S. job openings over the last 25 years. For 2 decades, the lines moved in near-perfect lockstep. More jobs meant more spending and higher profits. But recently, the lines snapped apart. While stock prices soar, private sector job creation has stalled at net zero. Major corporations are now reporting record earnings from automation, even as they eliminate thousands of human roles to protect margins. The government's financial health shows a similar divergence. This red area represents true interest expense, the combined cost of Social Security, Medicare, and the interest on our national debt. In early 2026, these mandatory obligations exceeded total tax revenue by roughly 30%, meaning the government is effectively borrowing money just to pay the interest on what it already owes. Simultaneously, the $9.4 trillion shadow banking system is beginning to seize up. These private credit firms lent heavily to businesses and pension funds when rates were low, but as investors now demand their capital back, the system is facing a severe liquidity crunch that is reflected in the collapsing share prices of major financial institutions. Wall Street is currently pricing in a future of frictionless growth, ignoring the reality that the foundational pillars of the economy are overextended. This creates a systemic vulnerability, a structure where the jobs, the debt, and the credit markets are so fragile that they can no longer absorb an external shock. Since 1945, American economic strength has been anchored by Pax Americana, a system where the US dollar serves as the world's reserve currency. This dominance is maintained by the petrodollar, a mechanism that requires global energy trade to be conducted almost exclusively in US dollars. The physical security of this entire financial arrangement depends on a single geographic point, the Strait of Hormuz. This narrow waterway in the Middle East is the artery through which By simply closing this trade route for a few weeks, Iran can inflict enough economic pain to hold the global financial system hostage, forcing Western nations to choose between their geopolitical interests and a total domestic collapse. While the strait is squeezed, an alternative trade offer is being made to the world. Iran and its partners are signaling that passage remains open for those willing to settle their oil contracts in Chinese yuan or Russian rubles. Because the yuan isn't yet as liquid as the dollar, this transition requires an ancient medium of exchange. Nations sell their dollar reserves to buy physical gold, trade that gold to China in exchange for yuan, and then use that yuan to secure the energy their economies need to survive.
This chart proves the shift is already happening. Following the 2022 freezing of Russian dollar reserves, Swiss gold exports to the Gulf states surged. Countries like Saudi Arabia are increasingly swapping their dollar-denominated assets for physical gold and Chinese goods, building a financial loop that operates entirely outside the U.S. system. Geopolitical rivals have moved past direct confrontation. They have constructed a functional, gold-backed trade infrastructure that allows the world to bypass the U.S. dollar entirely, turning the petrodollar's greatest strength into its primary vulnerability. As the oil squeeze continues, the shockwave travels to Europe and the UK. Surging energy prices trigger a spike in inflation, forcing European pension funds and banks to find immediate liquidity to cover rising costs for food and fuel. In a liquidity crisis, these institutions must sell their most reliable assets first. They look to their massive holdings of liquid international debt to raise the cash necessary to keep their domestic economies from freezing. Because European and UK investors own roughly 40% of all offshore US treasuries, their need for cash results in a massive sell-off of American bonds. This flood of supply causes bond prices to drop, which instantly drives up the interest rates the US government must pay to borrow money. The physical blockade in the Middle East has now mechanically triggered a lethal interest rate spike for the US Treasury. This crisis hits at the exact moment the US government is already facing record deficits, making its own debt nearly impossible to service. This leaves the Federal Reserve without its traditional tools. Jerome Powell faces a situation where the two primary levers of monetary policy lead to the same result. If the Fed cuts interest rates to protect the job market and bail out the credit system,
They will be injecting liquidity into an economy already suffering from an oil-driven supply shock. This would likely accelerate inflation, making the cost of living even more unbearable. If they keep rates high or raise them further to fight that inflation, they will accelerate the collapse of the bond market and the shadow banking system, forcing a deep recession that the government can no longer afford to subsidize. Traditional monetary policy was designed to manage domestic demand, but it has no mechanism to resolve a physical supply chain crisis weaponized by foreign rivals. If the source of the shock is a locked trade route, changing the cost of money cannot manufacture more oil or reopen the strait. We are approaching 3 potential outcomes: a fragile peace treaty that leaves the dollar permanently devalued, a 2008-style credit crisis as Wall Street valuations finally collapse, or a total bond market failure that forces the Fed to print money directly into an inflation spike. The shift from a single dollar-based system to a multipolar, asset-backed reality is no longer a theory. It is reflected in the flow of gold and energy. Navigating this transition requires a defensive posture, eliminating consumer debt, maintaining high cash reserves, and prioritizing hard assets that retain value regardless of the traditional banking grid.